Welcome to the Microcap Brief. Today we're dissecting a critical strategic crossroads for any small growing company, the choice between forming a strategic partnership and making an acquisition. Both paths promise to accelerate growth, but the risks and costs are dramatically different. Instead of analogies, let's look at real-world situations to understand how these choices play out. First, let's look at strategic partnerships. The core appeal is gaining access to resources without a massive upfront cost or diluting shareholders. Consider the classic case of a pre-revenue biotech company. Let's call it BioPharm Inc. BioPharm has a promising new drug in development, but lacks the billions of dollars and the global sales force needed to run late-stage clinical trials and bring it to market. Instead of selling the whole company or raising a massive dilutive round of financing, they form a strategic partnership with a major pharmaceutical giant. In this deal, the giant pays BioPharm a significant upfront fee, agrees to fund all future development costs, and structures in potential milestone payments for hitting key targets. In return, the giant gets the exclusive marketing rights to the drug and will pay BioPharm royalties on future sales. For BioPharm shareholders, this is a massive win. The company gets a huge injection of non-dilutive cash, and the drug's path to market is now funded and de-risked by a partner with deep pockets and global reach. This is a prime example of a capital-efficient partnership that leverages the strengths of both companies. However, partnerships have risks, primarily a loss of control. Think of a small software company, we'll call it SaaS-Tech, that develops a niche product. They sign an exclusive distribution deal with a much larger tech company to get their product in front of more customers. For a year, it works great. But then the larger partner gets acquired, and the new owner decides SaaS-Tech's product is no longer a priority. Because the deal was exclusive, SaaS-Tech is now stuck. Their primary sales channel has vanished overnight, and they're legally blocked from seeking other distributors. Their growth story is now in serious jeopardy, through no fault of their own. Now let's contrast that with acquisitions. The primary driver here is control and speed. Consider a small, profitable e-commerce company. Let's call it direct-to-consumer brands that sells one successful product. They want to grow faster. They identify a smaller private company that sells a complementary product to the same customer base. Instead of trying to build that second product from scratch, they acquire the company. Because they are profitable, they can use a combination of cash and a small amount of debt to fund the deal. The integration is straightforward because the products are similar. Overnight, direct-to-consumer brands has doubled its product catalog and can now cross-sell to both sets of customers. This is a textbook example of a smart strategic acquisition that accelerates growth without crippling the company. But the risks of acquisitions are severe, especially when it comes to financing. Let's look at a final case, a struggling manufacturing company, Industrial Cup. Their core business is stagnant. To create the appearance of growth, they announced the acquisition of another manufacturing company funded entirely with new shares. The problem? They paid a high price for the target, and to fund it, they had to issue so many new shares that they doubled their total shares outstanding. This means each existing shareholder's ownership stake is effectively cut in half, a catastrophic level of dilution. Worse, the integration proves difficult. The two companies have different equipment and clashing cultures, and the promised synergies never appear. A year later, the combined company is still struggling, but now every shareholder's slice of the pie has been significantly reduced. This is a classic example of a value-destroying acquisition. So why does this distinction matter so much to you? Because the choice between these two paths reveals everything about a management team's strategy and their discipline with your capital. Your key takeaway is this. Partnerships offer leverage with lower cost, but carry dependency risks. Acquisitions promise control, but come with huge financial and integration risks. When you see a deal announced, your job is to compare it to these real-world scenarios. Is it a smart, capital-efficient partnership like BioPharm's, or a desperate dilutive acquisition like Industrial Co.? Thank you for listening to the Microcap Brief. Always look beyond the headline, do your own research,